All right, hello, welcome back into the Netpicks Inner Circle. In this week's trade of the week, I'm going to walk through a bearish position on QQQ. This is the NASDAQ ETF, and it's been incredibly overbought over the past number of months. The tech names have really led the charge to the upside. It's been difficult to get any type of selling on Apple or Amazon, Facebook for any length of time. Every dip continues to be bought on those names. Well, we're now reaching a point where these names only have so much more left in the tank. They can only hold the entire market up for so long. I'm not saying that these markets are going to completely tank out. Not expecting the market to completely fall apart, but a healthy pullback in the near term is certainly a high likelihood. So what I'm looking at here on the chart, this is a chart of QQQ using our options fast track system. It's our set of custom indicators that plot the entries, the targets, and the stops for us in real time. What I'm looking at down at the bottom is our %R indicator. It's a standard indicator in most charting platforms, but we do use some custom settings inside of it. Those custom settings help us identify the very best opportunities, looking for those overbought or oversold extremes. Well, you can see just recently we have gotten another overbought condition. We got up above -10 right here earlier this week. That indicates to us in the near term that we are overbought, but it's not enough to give us an immediate short trade because we know we've seen it here over the past couple of months. Overbought can stay overbought longer than any of us anticipate. I need to look for a few additional steps for confirmation. The first step is I need at least one candle to close below our signal line. That is the solid white line on our chart. Well, we got that, and that happened here yesterday. Once that happens, the calculator knows how to read that, and it's going to plot an entry point on my chart, which, as you can see, there's an entry point, and it's at 180.49. That level was actually touched here this morning. Once that entry point plots in the chart, the final step is I need it to be touched. I don't need to close below that level. I just need it to touch intraday. So that happened here this morning. That allows us to put on a bearish trade, which we'll talk about in just a moment. The neat part about this is not only are the entry dots there for us, but we also have our target levels. We have two target levels that are already in place, and I also have a stop up above. Now from start to finish, everything is outlined for us in real time. If you are one of those people, you have a busy day, you may be working part-time or full-time, you've got other commitments that pull you away from the markets throughout the day, because everything is outlined for us, it literally takes us a few minutes each day to come in, check for new trades, get our trades placed, and then just allows us to move on with the rest of our day. It does not take hours on end on a daily basis to track these positions. So our first target would be at 178.12. That's purely a money management target. Once that level is hit, we will go ahead. If we're trading multiple contracts, I could take half of my position off there. At the very least, I'm just going to move the stop down to break even. If you're trading one contract, you're not going to take the position off at target 1. We're just going to move the stop down to the entry point. Target 2 is down at 177.26. That's where I would close out of any position that I have on at that point. And the stop initially is up at 183.82. So now the guesswork is out of the equation. Everything is crystal clear for me there on the chart. The next step is I need to decide what type of a position do I want to put on. I could just trade the shares of stock, but the problem there is if I want to short 100 shares of QQQ stock, it's just going to tie up a lot of capital. It can be very expensive to short stocks and ETFs. That's why we like to utilize the options at Netpicks. We like to use the leverage that those options offer. If I have to put on a bearish position, which the system is telling me to do here, I've got a couple of different choices. I can go ahead and just buy an outright long put. I can buy a put option. It makes money if that stock moves to the downside. The only issue I have there is we only have one way of making money on that trade. QQQ has to move to the downside, and it has to do so quickly. It's the only way I make money on the position. It's by far the most aggressive route to take. It gives us the most profit potential, but it also comes along with the most risk. Which if you are bearish, which I am actually pretty bearish here, just given how overbought the market is, I'm expecting a pretty quick pullback. So I don't mind being aggressive. But if I wanted to cut some risk, and maybe if you're one of those people that's saying, hey, the trend is clearly bullish, we've been super strong, especially the NASDAQ, I don't really want to jump in with both feet on the downside yet. Fair enough. What we could do there also is utilize a vertical spread. Right? So we could either buy a put spread or we can sell a call spread. What we're going to do for the trade of the week here today is I'm going to take a look at selling a call spread. The reason I'm going to take this approach, I do want to be pretty bearish. I wouldn't mind buying a long put here. But the reason I'm going to take a look at selling a call spread is I want to have multiple ways of making money on the trade. Here we are, middle of August, the summer doldrums. We've got a lot of low volume movement right now. There hasn't been a lot of action. I'd rather give myself more ways of making money on the trade just in case this market doesn't make a quick move to the downside. By selling the call spread, I give myself more ways of making money, which we'll see here in just a moment. But I also give up the home run profit potential. If this thing really tanks out over the next week or so, I'm going to make less money on the short call spread. So there's pros and cons here. What I am shooting for, I want to have the higher probability of success. Okay, I'm looking for multiple ways of making money in a very dull market. So let's go over to the trade page and let's start to talk about this trade. All right, if you take a look at the QQQ trade page, I've got a decision to make here. If I want to sell a call spread, which again, I know some of you that might be newer to options trading, you're saying, okay, I thought we were supposed to use calls if we wanted to be bullish, right? And buy a call if we wanted to play the move to the upside. Well, in this case, we're selling a call spread, which is actually a bearish position. I want QQQ to move to the downside. The difference here is instead of only making money in one type of market, if it makes a move to the downside, I can also make money if it chops sideways. I make money from time decay adding up, from volatility decreasing. I'm just going to increase my probability of success long term. So I'm going to take a look at the September monthly options. They have 42 days left. This is a little bit longer term position. I'm going out a little bit farther in time just in case we're a little early. Just in case this market does not decide to go lower. What if we just kind of chop sideways or drift higher here a little bit here in the near term? I want to give myself more time to be right on this trade. So I am going to go out to the September monthly options. We have dollar-wide strike prices out in those September options. I'm going to go to the out of the money calls. I'm going to go out to the 184 calls. They've got about a 64% chance of closing out of the money. I typically want to take a look at options that have around a 65% chance of closing out of the money. Right, so that one's pretty darn close. I'm going to right click on the 184 calls. I'm going to go to sell and I'm going to select vertical. That's going to load up a spread down at the bottom of my page where I am selling the 184 call and I'm buying the 185 call to make it a risk-defined trade. I can collect 44 cents here to put this trade on. What I'm looking for when I sell a vertical spread is I want to collect between 30 and 40% of the width of the strikes. There's a dollar-wide difference between these two strike prices here. So I want to collect between 30 and 40 cents. This one I can actually collect 43 cents, which is actually an even better number. I can collect a little bit more profit. But do I have some flexibility here? What if I adjust these strikes? Ideally, when I sell a spread, I would like to get those strike prices as far away from the current stock price as I possibly can get. So what if I move those strike prices from 184 to 185 to 185, 186? Now I go down to 36, between 36 and 37 cents premium collected to put the trade on. It still meets my criteria. I'm still collecting between 30 and 40% of the width of the strikes, but now what I'm doing is I'm pushing my break-even point farther away. That's exactly what we want when you sell a credit spread. Our way of making money on this trade is if the trade goes to zero. We want it to get as cheap as possible. So that's why if I can sell as far out of the money as I can get, that's going to allow me to have a higher probability of success. So let's call this, I know it's kind of bumping back and forth between 36 and 37 cents. Let's call it 37 cents. Let me go ahead and click on confirm and send, and let's break this trade down in detail. I am collecting 37 cents up front. That's the most I can make on the trade regardless of what happens. So if QQQ really collapses over the next couple of weeks, the most I can make is $37 per spread, which at initial glance doesn't look like a whole heck of a lot, right? Here's the beauty. I'm only risking $63 per spread to put the trade on. You can do this trade with less than $65 of capital. That's pretty attractive. If you've got a bigger account size, sure, you can trade 10, 20, 30 spreads. You put it on 10 times and now all of a sudden you've got $370 of profit potential with only $630 of risk. So with these types of trades, you're able to control your risk really, really easily. We're right around a risk 2 to make one scenario. That's very typical for us. I know a lot of times when people see that ratio for the first time, they say, hey, I thought that goes against what a lot of people teach, making sure your winners are larger than your losers. Here's why I'm willing to accept a risk 2 to make 1 scenario. I've got 5 different ways of making money on the trade. My break-even point is at 185.37. It's calculated by taking my short strike. It's the 185 call that I'm selling. We're adding on the 37 cents that I'm collecting to put the trade on. That gives me the break-even point at 185.37. I don't care if QQQ moves up, down, or sideways. As long as it stays below that break-even point, I get to make money. Even if it closes below that level by 2 pennies, I can still make money. So ideally, I want QQQ to move to the downside. If it doesn't, say it moves sideways or even moves slightly higher, I can still make money. I have 3 different directional movements that stock can make, and I'm still okay. The only move that hurts me is if QQQ makes a big move to the upside, which I think the chances of that happening are pretty slim. The NASDAQ is already extremely overbought at these levels. With price action at 180.93, this thing can move about $4.50 to the upside against me, and I can still make money. See how we're starting to stack some things in our favor? If all I did is buy the long put, yeah, I had bigger profit potential, but I only make money if QQQ moves to the downside quickly. And this type of a trade, by selling the call spread, I have 3 different directional moves the stock can make, and I can make money. I also make money from time decay adding up, and I make money from volatility decreasing. There's 5 different ways of making money on this trade. Does it give me a huge profit potential? No, but it gives me a high probability of success. This is a trade that I can put on, generate some income without needing the market to make a big move. I personally think volatility is going to explode here between now and the end of the year. I just don't know if it's going to happen in August. August tends to be a slower month, at least the first half of the month, because it's prime vacation season for a lot of people. The volumes in the market tend to be pretty low. So by going out into the September options, it gives us time to hold on to the position. It gives us time to be patient on the trade just in case it takes longer to develop. And every day that I hold that trade, the time decay starts to work in my favor. This trade has a very high probability of success. Those 185 calls that I'm selling have almost a 70% chance of closing out of the money. That's exactly what we want to have happen. So there's a very high probability that this trade is going to work out in our favor. If it does, we're going to be able to book a really nice profit. Where's my initial target zone? I'm looking to keep between 50 and 75% of whatever I collect to put the trade on. So if I collect 37 cents, if I can buy that thing back for between 9 and 18 cents, I'll look to do so. And that could happen anytime over the next few weeks. So if we do get a nice move to the downside over the next 2 weeks, there's a pretty good chance that we're going to be able to close it out and try to book a 75% profit. Why would I close it out instead of holding on for the full profit? Because if I can book 75%, it allows me to book that profit, free up the capital for another new trade. And it just helps increase my performance long term. That way I don't have to mess with expiration. I don't have to mess with the activity that you get expiration week. I can go ahead and book the profit early. So we'll go ahead and put this trade on. I will continue to track it here on the blog. If you have any questions at all, feel free to post a comment here in the blog, or you can email me directly. Mike@netpicks.com is the email address, and I will certainly be in touch right away to help out. All right, so again, our trade of the week, selling the call spread on QQQ. It's out in the September monthly options, and it's the 185, 186 call spread, selling for around 36 or 37 cents. All right. So I'm going to wrap this video up here. Enjoy your weekend, everybody. We'll be back here next week with our next trade of the week.